Welcome to the Block Time podcast, powered by Riot Platforms. Today, we don't have a guest. It's just me and producer Gabe behind the monitor.
As always, nice to see everybody on the episode.
This week, I wanted to take a time to do a deep dive into Bitcoin's transaction fees. I think Bitcoin transaction fees are a pretty complicated topic and a controversial one as well. Last year, we published a research report with Joe Burnett on this topic that was looking at how do transaction fees work in Bitcoin, what has driven them in the past to either be low or high, and kind of what should we expect going forward. So I wanted to go through that research report. Perhaps we'll have some updates since it has been a year since we published it, but I think by and large, it holds up as being rather perennial and unchanging, much like Bitcoin. Okay, so first we have to look at where do transaction fees come from? And this part is kind of counterintuitive. So when we look at a Bitcoin transaction, it has two halves to it, right? You have what is being spent, and where is it being spent? So you can think of it from an accounting perspective, the debits and credits, and those have to balance out. So if you want to send one Bitcoin to someone, you're going to have to unlock one Bitcoin that you already have. Now, when you unlock one Bitcoin, perhaps you have received two Bitcoin. So you're going to have to unlock two Bitcoin, send one Bitcoin to your friend, and then the other Bitcoin would come back to your wallet as change. So in a typical Bitcoin transaction, you might have one or more inputs that are Bitcoin that you are unlocking, and then one or more outputs that you are locking up to, which will likely include a change address going back to your wallet. So this episode, we're looking at things from a rather technical lens because we want to go in depth, but it's really important to clarify this area that most of your wallet software will handle these concepts for you. So when you're looking at your Bitcoin wallet, all of this is happening behind the scenes. But if you really want to understand Bitcoin, you have to understand what's happening under the hood. So when your wallet is creating a Bitcoin transaction, it is looking at what can it spend by creating inputs, and where should it spend to by creating new outputs. So you would expect that both sides to match, right? The debits equal credits, but this is where we find transaction fees. So you actually unlock more Bitcoin than you lock up. And so there's a residual number of Bitcoin that if you just look at a transaction in isolation, it looks like the Bitcoin are disappearing in the sense that the transaction fee is not going anywhere. It's just a residual amount that is the difference between what you're unlocking and what you're locking up. Now, where it starts to make sense is when you put that transaction inside of a block, so a batch of transactions, because the transaction fee from that transaction, from all the transactions, is actually being absorbed into the mining reward that is going to get paid to the mining pool that has found this block. And so that's where the transaction fee is going. It's not just disappearing. It is being summed up into the transaction that is paying the miners. So the miners are being paid for including this transaction in a block.
Pierre, quick question.
Yeah.
So when you're figuring out what the transaction fee actually is it proportionate to how much I'm sending or how much I'm unlocking versus the entire block, or is it a set fee amount per each transaction?
Great question. So it's a little bit counterintuitive because it's neither. It's based on the amount of data that the transaction is taking up. So you could have a transaction that is moving very little amount of value, but it has many inputs and many outputs. And so it's taking up a lot of data, and you have to pay a high transaction fee because of that.
So the transaction fee is based upon how much data you're moving, but not necessarily how much Bitcoin you're moving.
Correct.
Okay, and not proportional to the size of that transaction on the block per se.
Well, if we're talking about the data size, yes.
Yes, data size. Got you. Cool.
And you could also have a situation where you could be moving billions of dollars worth of Bitcoin, thousands, tens of thousands, hundreds of thousands of Bitcoin. And if you only have one input and one output, you could pay, a penny for your transaction.
Or the equivalent of a penny in SAT.
Right, in SATs terms. Thank you. Yeah, 300 SATs. Then it's an interesting question you bring up, because you could ask, well, why is it this way? Right? We don't want to just accept that it is. Let's poke around. So the reason why it's based on the amount of data that is being consumed is because ultimately, when the miner is looking to include transactions in a block, they're looking at how many transactions can they fit into the block because of what's called the block size limit. And even without this block size limit, they would still care about this for other reasons. But so if we look at the block size limit, this is something that Satoshi put into the Bitcoin software in 2010, just as right before he was leaving the project. He really wanted to find ways to make Bitcoin more resilient and harden it against possible attacks. One of the attacks that is possible without a block size limit is essentially a denial of service attack, where you would create a very large block. Let's say it's a gigabyte. And it's so big that anybody who's running a Bitcoin node on their laptop at home or on a server even, perhaps the size of that block would overwhelm the resources of their computer and cause their node software to crash and knock them off the network. In which case, if nobody can run a Bitcoin node except large mega corporations or governments, so if only Google could run a Bitcoin node because the blocks are so big, then Google would get, and Apple and the big tech, they would get to set the rules of the Bitcoin network. So including giving themselves more Bitcoin. So the only way Bitcoin can be decentralized is if running a Bitcoin node is inexpensive. And putting lots of data onto the blockchain, that drives up the cost of running a Bitcoin node and makes Bitcoin less centralized, or less decentralized. Sorry. Now, the challenging part, which has led to a lot of debate in the Bitcoin community and in the wider cryptocurrency world, is where do we draw the line of how do we onboard lots of new adopters onto the Bitcoin blockchain and keep the Bitcoin blockchain size reasonable so that we can afford to run a Bitcoin node and keep everything decentralized. Unfortunately, there is not a quantitative singular answer to that question. It's rather qualitative, and there's probably a range of values where the block size limit could have been set. Satoshi kind of pulled 1 megabyte out of a hat, and he decided, hey, we're going to set it to 1 megabyte. Whether that's the absolute correct number in 2010, is up for debate, but nevertheless, it is a number that became very hard to change because Bitcoin's rules require a certain amount of rough consensus in order to be able to modify them. What did happen, though, is that at the end of 2017, the Bitcoin community, Bitcoin nodes, Bitcoin miners, Bitcoin developers adopted this upgrade, SegWit. SegWit essentially transformed the 1 megabyte rule into more of a 2 to 4 megabyte rule. Now, how it did this was rather complex and created kind of a new unit of account of block weight in order to be able to fit more transactions into a block. And so in our research report, we've got a chart kind of showing how much data was being consumed by SegWit versus traditional legacy transactions. And it shows that there's been a tremendous amount of growth in terms of the adoption of SegWit since it was activated in 2017. But all this to say that this block size limit, it still exists today, and it still limits the number of transactions that can go into a block. And so the miners and the mining pools, when they have to choose which transactions to include in a block, they rank order the transactions based on how much is it paying in fees per amount of data. So the unit there is sats per vbyte. So monetary value per amount of data. This fee rate is very competitive. So people are competing to get their transaction into the next block. The way that they're competing to do that is inside of what's called the mempool, which is essentially a queue, a backlog of transactions that are waiting to get into the next block.
Sorry if this is a naive question here, but to me, when I hear that the block size limit is 2 to 4 megabytes, and I'm speaking from the perspective of I have video files that are, gigabytes, right? So what does that really look like as far as the block size limit? Is that really a lot of data or really not?
Yeah, so that's a great point. And in the research report, we've got a chart about the monthly transaction data use. And, 1 megabyte is it's not a lot of data. But if you're doing, 1 to 4 megabytes every 10 minutes, historically, in 2022, it was adding up to 5 gigabytes a month. And 5 gigabytes is okay, but you also have to think about it being cumulative. So now the Bitcoin blockchain is upwards of 500 gigabytes. And so if you're kind of launching your Bitcoin node today, that means you have to download hundreds of gigabytes of data and the reason just rewinding here, the reason you want to download all of this data and have the whole blockchain and not just part of it is that you want to verify the monetary policy of Bitcoin. And the only way to verify the global monetary policy is to verify every transaction that has ever happened, just in the off chance that one of those transactions is creating new money out of thin air that they're not allowed to.
Okay, so that's where I didn't see the whole potato there. So you have to have the entire blockchain on your node in order to then process the next 4 megabyte block or whatever that size block would be then.
That's exactly right.
Got you. Okay,
yeah.
Cool.
Now, the good part is that you can, after you've downloaded the data and you've verified it, you can delete it. And so that's called pruning. You can turn that on your node so that you don't have to store all that data on your hard drive. Now, hard drives are, pretty high capacity nowadays. You can get like a 4 terabyte, 8 terabyte hard drive.
Yeah, I saw recently like a little image on, I guess it was Facebook, that, you had a 5 megabyte computer or hard drive back in the day in like the 80s or the 70s or whenever that was, that it took up a whole room.
Yeah.
And now we have terabytes on micro SD cards, which is insane.
It is. Yeah. So, and the improvements in the technology have raised the question of, okay, this was maybe correct for Satoshi in 2010, but in 2023, maybe we should be at, 10 megabytes or something. And that's where we get into the difficulty of getting rough consensus in Bitcoin, which is that, there's not a correct number. And so once we start opening Pandora's box of changing the number, everyone wants to throw out their proposal of, it should be 12 megabytes or it should be 8 megabytes or 14. And so I think that's been the challenge, is that there isn't really another number that strikes us as being magically correct.
Yeah, and then who all is deciding on that? Like, how many people have to sit down and agree? Like, yes, we should raise the limit again.
Because Bitcoin is decentralized, there's
Correct.
not an answer to your question.
Correct. Yeah. Right.
It's perplexing. Of everybody's in charge, which means that nobody's in charge, right? That's one of the paradoxes of Bitcoin. Yeah, it's a lot of data. And so if you're running, on dial-up, you wouldn't be able to download 500 gigabytes of data and catch up. If you're on fiber optic, you can download it in a few hours. So it does raise a kind of an equity or fairness issue there as well, in terms of Bitcoin being a global monetary system that, we want to have everyone in the world on here. That means we've got to think about what is the dispersion? How is technology being adopted globally? Perhaps when everybody has a fiber optic internet connection, we'll have an easier time increasing the block size limit. But that in itself is a controversial statement.
Right.
In the meantime, the block size limit does exist, which means that when we do reach it, this is where I think we can talk about congestion pricing. Essentially, that Bitcoin's transaction fees tend to skyrocket when we reach that limit. And in the report, we kind of look at what happens, first of all, that causes this congestion. I think it's a combination of what I would call fundamental adoption of, hey, people are actually using Bitcoin wallets to make payments to buy their coffee, let's say, or, buy a computer online or buy some graphics, whatever it is. So there's that. And then you have the traders. So the traders are using the Bitcoin network to move Bitcoin between exchanges and to perhaps arbitrage and make a profit. But you also have new adopters who might be looking for a long-term savings vehicle. And so they want to buy Bitcoin on an exchange, withdraw it from the exchange using a Bitcoin transaction onto their hardware wallet for long-term savings. And then you also have folks who have long-term savings. And then when the Bitcoin price goes up a lot, they plug in their hardware wallet and they transfer Bitcoin from their hardware wallet to the exchange so that they can rebalance their portfolio, pay off their parents' mortgage, put their nieces and nephews through college, or whatever the motivation is there. Maybe buy a Lambo. Hopefully, it's more noble than that.
Yeah, what's the best use of your Bitcoin, right?
Yeah, that's between you and God. At the end of the day, work with a financial planner, kind of figure out what you want to do with your resources.
So you don't suggest buying Lambos in Bitcoin?
I mean, if those are the circumstances you find yourself in, that of buying a Lambo is the best thing for you to do, who am I to judge? You're a car guy. There's better cars than Lambos.
Oh, absolutely.
Put money on.
I'd be first in line for the GT3 RS or something like that. Porsche.
Yeah, that's more tasteful. I feel like Lambos like new money. I'm gonna buy.
Oh yeah, Lambos are very
car.
new money. Yeah.
Do you even really take a Lambo to the racetrack? Like,
I mean, they make a couple of models that are like specific, actually really good handling cars. But when I think of Lambos, I just think of super wide Aventadors that, they just sound really good and look really good, but they don't necessarily handle as well as a road car does.
We're going to get so much hate mail from the Lambo enthusiasts.
Oh, yeah. There's going to be so much down the pipeline.
Yeah. The YouTube comments are going to be filled with, hey, you guys are just jealous you don't have a Lambo.
I think I'm jealous that I don't have a Lambo. That's why we're talking bad about them.
Yeah. Yeah. All right. That's kind of what is driving a lot of the activity on the blockchain. And that means that when the Bitcoin price is having kind of those parabolic moves, there's lots of activity on the blockchain, and you get into congestion pricing, where all of these different users are competing against each other to get their transaction into the next block. And so we've seen transaction fees go up to, in dollar terms, like $30 per transaction. And that causes a few things. One is that it causes some behavior changes of, okay, maybe I won't move my Bitcoin around right now and I'll wait for kind of the storm to pass by. And that might be okay for you if you're not in any particular hurry. So that's one behavior change. The other is that it might spur you to use other Bitcoin scaling solutions. So for example, you might use Bitcoin's Lightning Network in order to make your coffee payment, because the transaction fee on Lightning, the routing fee might be a fraction of a penny, whereas that would be a lot more expensive on chain. So I think that it has an impact there. But more realistically, I think what ends up happening is that the mania of Bitcoin's price kind of passes, and then a few months later, there's relief in terms of how much demand there is for transactions, and that naturally drives down transaction fees during those times as well. So we saw after 2017, transaction fees plummeted from $30 a transaction to pennies per transaction. The other big change that happened, and this was really in mid 2021, during that bull market, is that we saw a major wallet, the blockchain.com wallet, adopt SegWit. And so by adopting SegWit, they dramatically reduced the on-chain footprint of their users, and that freed up space for other transactions. So the congestion pricing, it gets solved through user behavior changing, but also it gets solved through technological upgrades that allow for more efficient use of block space. Another big upgrade that happened, so there was SegWit in 2017 that activated, and then in 21, we also saw the activation of Taproot. And so with the activation of Taproot, that means that eventually multi-sig transactions, which include Lightning channel open and closing, will take up a much smaller footprint as well. And so it'll increase kind of the throughput effectively of the Bitcoin network longer term. All right. So these cycles have happened a few times already. I think that they will continue to happen as long as we see Bitcoin adoption happening in waves. And this, for better or for worse, humans are social animals. So we get caught up into the mania of all wanting to get into Bitcoin at the same time. And so I think that we'll continue to see congestion pricing for transaction fees during the bull market. And then in the bear market, there'll be relief from that pressure and transaction fees will decline again. Interestingly, what we saw in this bear market was, really towards the bottom of the bear market, right? Of when we look at when the Bitcoin price was at $17,000 a year ago, we saw the emergence of a new phenomenon called ordinals. And so Casey Rodarmer came up with a new way of approaching how Bitcoin gets looked at through a different lens, which he called ordinals. So this basically was a way of attaching a serial number, with a somewhat arbitrary methodology, but kind of the simplest one. And so usually that's what catches on is, keep it simple. And what having a serial number for Satoshis, having a lens to attach those serial numbers to it enabled was people developing the equivalent of NFTs on Bitcoin, which he described as inscriptions, but also kind of people just adding any kind of data and attaching it to Satoshis in kind of a virtual layer, which includes trading what they ended up calling BRC20 tokens, which is a play off of Ethereum's ERC20 tokens. And this allows somebody to essentially issue their own currency and have the transfer of that currency happen on Bitcoin's blockchain. Now, the downside is that because this is a bit of a hack on top of the Bitcoin blockchain, you don't get any of the guarantees that you have in terms of the scarcity of it, or kind of the semantics, the rules of it that you have with on-chain BTC. But nevertheless, it took off in popularity. The degen started trading inscriptions and BRC20s, and that actually drove up a lot of transaction fees and a lot of block space usage in the early part of 23. And so this is a case where I think for the first time in Bitcoin's history, you had congestion pricing that was not related to a bull market mania in BTC USD, but rather it was about people finding a new use case for the data on chain. Now, how long that will last, whether it's an enduring trend or not, to be seen.
Pierre, not to backtrack any, but I wanted to ask real quick. So what is it going to take for the transaction fees to kind of gain like a predictability or like a leveling? So like, I understand it's tied to adoption and how much transactions are happening. You said it had to do with the bull and the bear markets, but what is it going to take for these transaction fees to like level off completely and become like a new normal,
Yeah, that's a great question. So I think that in a way it is tied to when do we expect the Bitcoin price to also do the same, Bitcoin's purchasing power. I mean, I think that at some point we will reach 100% adoption.
Mm-hmm.
And so there won't really be any waves of adoption and things will normalize. And so transaction fees will kind of just go sideways. I think the open question is, at what level will they go sideways? Will they go sideways at a very low fee rate, or at a medium fee rate, or at a high fee rate? And this, I think, is still being debated. I kind of I'm in the middle camp, mostly because I think both sides have good arguments. And so that's why I end up in the middle rather than there being good arguments for the middle. So on the cheap transaction fee side, basically the idea there is that there will always be scaling solutions that drive down transaction fees, or that people don't necessarily want to use on-chain Bitcoin because of its finality, in the sense that they would rather use a layer on top of Bitcoin that is reversible, because that way they have like consumer protection, or even, people say, hey, look, like Visa's cash back, like that's never going away. And so people will always use even when Bitcoin has full adoption, people will be using BTC as their unit of account for their Visa credit card rather than actually using on-chain Bitcoin. I'm skeptical of that. And I think that there's advantages to having finality, and that merchants, when we had Parker Lewis on, he was talking about how that cash back comes out of the pocket of merchants.
Right. Yeah. So it's like, to me, whenever I hear about, credit card transaction fees, it's never necessarily the consumer that's paying those fees. It's always the merchant. And in the case of Bitcoin, it's the other way around, correct?
That's correct. Yeah. The sender of the Bitcoin transaction,
right,
who is the consumer,
right,
is the one paying the fee, which then puts the onus on the merchant to say, hey, I'd prefer to receive Bitcoin,
so that they're not paying credit card fees.
Yeah.
And whatever that may look like as far as hardware to receive, credit card swipes, or just being a part of that network as a whole.
Yeah. Yeah. And the problem of credit card fees and cashback has been, even outside of the Bitcoin world, of people trying to get Bitcoin payment adoption, in the world of Washington, D.C., they want to regulate that because they do see it as being price gouging, essentially, of this sneaky way of extracting lots of value from Main Street and funneling it to Wall Street.
Correct.
And so, there's like people talk about the Durbin Amendment, which is a way of capping those fees, from a regulatory legislative perspective. And all the lobbying and politics that goes into that. But I kind of see it as like, hey, let's have competition, and I think that Bitcoin and the Lightning Network can be that competition.
Right. So the combatant against the credit cards in a short term is more of the Lightning Network.
Yeah, that's right. And that's where we get into another interesting debate about transaction fees on Bitcoin. Of perhaps they'll be very low because all of the payments will be happening in the Lightning Network.
Right.
And so it kind of cannibalizes the demand for block space by moving everything off chain. The counter argument there is that participating on the Lightning Network also requires an on-chain transaction to open the channel and to close the channel. And then where the debate ends is, okay, how many channel opening and closing do you need per person? I'd say you probably need like 8 per person per. I'd go so far as to say like per couple of years. So let's say 4 per year. So 4 transactions per year per person, and then you multiply that by, I don't know how many people there are, 8 billion people.
Yeah.
That's still greater than the block size limit.
Correct.
And so then that's an argument for fees being high. Of, hey, there's just not enough block space to onboard everybody on chain onto Lightning, or even to use their cold storage, for not their payments, but for their long-term savings. They still need to do an on-chain transaction. And so you'll see people worry about how can Bitcoin be decentralized if everybody's having to use custodians because going on chain is too expensive.
Correct. Yeah.
And so we have the low fee and the high fee.
And then you're back to trusting the holder, right?
Yeah.
Yeah.
And I think that, we could debate the future, but we also benefit from looking at the past, which is that even in environments of low fees, we still see a lot of people using custodians, whether it's custodians that are, I'll put air quotes around this, trustworthy, like Coinbase,
right,
or fraudulent, like FTX.
That's where I'm thinking, like, immediately when we're talking about this. It's
like
the custodian has to be trustworthy because we don't have the ability to hold everybody, to on-chain transactions all the time, immediately.
Yeah, and like Satoshi's white paper is, hey, let's get rid of these intermediaries. Let's
Correct.
not have these custodians. And so I think that's the scaling debate in a nutshell is, how do we get everyone to not have to rely on a custodian and to be able to run a Bitcoin node? Because if you're relying on somebody else to run a Bitcoin node, that is also very similar to having a custodian. So it's kind of like, do you have to rely on somebody else for your private keys or rely on somebody else for your network information, for running the monetary system?
So where do you see the ideal?
I mean, the ideal is both, right? That the ideal would be that we are able to find scaling technologies that make it so inexpensive to run a Bitcoin node that we're able to raise the block size limit, to infinity, and that people are paying low fees and running their own node, and it's all happening in the background, and everyone's happy. But there's trade-offs in the software engineering. But there's trade-offs today, but we don't know what cryptography in many instances can kind of be magical. And so you can have cryptographic breakthroughs where you get a free lunch. And I wouldn't, that has happened in the past. So, and I would kind of look at SegWit and Taproot as examples of that. And that's why they happened, is that they were able to get rough consensus because they provided a free lunch in the sense that they provided advantages without creating more problems. And so I think that there's still hope that researchers will be able to find ways to improve the protocol that get us towards an ideal world. But we're not there today.
Gotcha.
Yeah, and even with Coinbase, like people use Coinbase even when transaction fees are low, people still like rely on Coinbase to be their custodian, not because they're trying to avoid high transaction fees, but because they have anxiety about holding their own private keys, or
And I
they're
think
just
also
ignorant.
that people are just comfortable having a custodian.
Yeah.
I mean, in the USD, we always have had a custodian with banks or whatever it may be.
Yeah, and so where I end up is, Satoshi's white paper of not having any intermediaries. You could look at it as you have the option to not have an intermediary. Doesn't mean you have to exercise that option if you don't want to, but it should be on the table. And that way, if you look at it through the lens of a negotiation, then you are in a better negotiating position of, hey, I can always opt out of using Coinbase if they're not creating the value that I want from a custodian. Whereas in the traditional banking system, if you want to send a digital payment, you have to always rely on a custodian. You don't have a way of opting out of centralized systems. And so it's really about optionality.
Yeah, and I think that people are just so accustomed to not having the option that they'd rather just use a custodian like Coinbase.
Yeah, and there are advantages to using a custodian like Coinbase, even if you're aware of the option, and even if you're comfortable with holding your own private keys. One of it is that you might, all the examples I can think of, I know that somebody's going to come out and be like, actually, but realistically, like if you are trading Bitcoin, not that you should be trading Bitcoin, right? You should be long-term buy and hold. Yeah. If you are, then you actually, you do need a custodian because it's very challenging to trade directly from your wallet because it takes time, and trading of Bitcoin happens, in real time. And so realistically, you need to have Bitcoin on the platform. Yeah. But that's something that people will be like, well, you shouldn't be trading Bitcoin. So that's okay. So yeah, let's see. Where can we take the conversation next? So, I think that we could then look at it from the mining perspective.
Okay.
Which means that, Bitcoin transaction fees being so volatile throughout Bitcoin's history has meant that Bitcoin mining revenue, transaction fee revenue, has been very volatile. And so, Bitcoin miners, they have two big sources of revenue. They have new Bitcoin being added to the ledger. And that started out as 50 Bitcoin every 10 minutes in 2009. Got cut in half by the halving in 2012. So it's 25 Bitcoin. Now, the halving is hard-coded into the Bitcoin software, into the node software. And so there's not really any way for the miners to stop the halving from happening. They would if they could, or they would increase it, the doubling. But that rule is set by the nodes. And that's Bitcoin's monetary policy. And that's what allows for us to say that there will only ever be 21 million Bitcoin. It's because if you have a halving every 4 years and you start from 50 Bitcoin every 10 minutes, then by the year 2140, you will have a maximum of 21 million Bitcoin.
So that's the year, that 2040?
2140.
Oh, 2140. Got
Yeah.
you. All right.
We'll be long gone. I mean, unless we figure something out.
Yeah. That's what was so surprising to me is when I heard that, the vast majority of Bitcoin has already been mined and that we're only mining the last, million?
Yeah. So, 19 million Bitcoin have been mined, and we're all scrambling to mine the last, I think it's, 1 point something million.
Right. A little under 2 million.
Yeah. But if you look at it, 99, like you'll be at 99.99%.
Correct. Just because of the halving.
Yeah.
Right.
Long before 2140.
Right.
Because 2140 is really when the last Satoshi.
Yeah. At that point, you're not receiving whole Bitcoins anymore as far as the every 10-minute thing. Right. Yeah.
That's right.
Which is crazy to me. I mean, it makes sense. It does. But from a mining company's, perspective as far as longevity goes. So what's the next thing after 2140? What's happening? We're just, we're mining for the sake of the transaction fees, right?
Correct.
Yeah.
Yeah. And even long before that, we would have transaction fees be a large percentage of the revenue.
Right. There will be a certain point where the revenue crosses from majority being new Bitcoin on the chain versus the revenue that you're making from the transaction fees and verifying blocks.
That's right.
Very cool.
There are some specific blocks where that has happened already.
Ooh.
Where the transaction fees in that block were greater than the new Bitcoin being added.
When was this?
Earlier this year, I believe in January, we had a few of those blocks. Every time transaction fees spike,
right,
some of the blocks in there are like that.
That's pretty interesting.
Yeah. But if we look at like the end of 2017, it spiked up to like 40% of the miner revenue was from fees. And then you really have to zoom in to find those days where it's 51% or greater, right?
And a technical question.
Yeah.
How do miners receive those revenues from transaction fees? So it goes through a mining pool, or how does that work?
Yeah, great question. So it does go, assuming the miner is using a mining pool.
Correct, yeah.
And this is where we kind of get into sometimes it's a semantic debate about who the miner is. Mm-hmm. I consider who the miner to be, who is performing the SHA-256 squared hashing, right? And you could call them, who's the hasher? Mm-hmm. And so, Riot, we self-mine is what we, describe that as. And so we are a miner because we are, our mining rigs that we own are hashing. Then the mining pool is really a convenience in the sense that they aggregate hash rate across different miners in order to smooth out the earning of block rewards. Because if you only have 1% of the hash rate, that means that you get 1 out of 100 blocks, and there's 144 blocks per day. So you would get, 1 block per day, assuming that luck is constant. But as anybody is familiar with, the Romans called it fortuna. Luck is not constant; it's random, and so you could find yourself, with lots of days of not finding a block, and then finding like 5 blocks in one day, right? You're sitting at the roulette table, and if you join a mining pool, then you can smooth out those rewards so that you are more consistently delivering results, which I think is what the miners want because they've got bills to pay. Mm-hmm. So that's kind of the advantage of being in a mining pool, which means that the mining pool operationally is receiving the block reward and then divvying it up.
Yeah, they're divvying up then the transaction reward, the transaction revenues then.
Yes, that's correct. Yeah. And we could probably do a whole episode on the divvying up, mm-hmm. because there's different ways of divvying it up, of calculating, the shares reward, that would be, I think, an interesting episode. I'd have to do research on it because I can tell you off the top of my head, FPPS, like all of this stuff, the exact math on it. But it's an interesting area.
Gotcha. Yeah, sorry if I'm asking too many questions. I know that
this is good.
Yeah, my understanding is a lot lower than yours. So whenever I hear something that I can learn, I'd like to ask questions.
Yeah, and you will reach the limits of my understanding because these are smart questions. So this is good. It helps the episode fill out.
Yeah, well, I know you got slides too, so that helps.
Yeah, we'll be able to cut in some of these charts on the video.
Sure.
So the transaction. So back to the halvings. So these halvings happen every 4 years worth of blocks. So it's actually 210,000 blocks that it gets calculated on, which means that the exact calendar date on which it happens depends on what's happening to the difficulty adjustment and the hash rate. Mm-hmm. So if lots of hash rate is being added, which currently is happening, mm-hmm. then the halving happens sooner.
Sooner, yeah.
which is weird. It's
So
like
how
time
often does
dilation.
the difficulty change?
Every 2 weeks.
Every 2 weeks.
Worth of blocks.
Interesting.
Yes. So it can be, if blocks are coming in quickly because we've got lots of hash rate coming online, it'll be 12 days.
Mm-hmm.
And then
The difficulty adjustment happens then.
yeah, it'll increase the difficulty. And so then from there, it should be 14 days.
Why isn't the difficulty adjustment like almost real time?
Because of the luck. So if you did it real time, it would constantly be adjusting up and down.
Mm-hmm.
And so you kind of want to smooth out an average. Because then if you get really lucky, then the algorithm will think that lots of hash rate is coming online.
Got it.
And people will look at estimates, real-time estimates of hash rate, and it's kind of misleading because you'll get lots of luck, up, and then bad luck down. And so you'll think hash rate is changing when really it isn't.
It's just luck.
Yeah.
Interesting.
Yep. And so zooming out to 2 weeks kind of provides a better sample of what is actually happening to calibrate this decentralized clock so that it ticks every 10 minutes.
Yeah, that's pretty interesting.
Yep. So the first halving was in 2012. So we got to 25 Bitcoin per 10 minutes. Then the second halving happened in 2016, 12.5 Bitcoin every 10 minutes. The third halving was in 2020. So that was 6.25 Bitcoin. The next halving is next year, fourth halving, and we'll be at 3.125 Bitcoin every 10 minutes.
I was going to say something stupid like 3.15, but I'm glad you said 3.125.
Yes, I've given this talk enough times that I've
you
got
remember
the
that
numbers.
decimal.
Yeah, and then I'm going to have to memorize 3.125 divided by 2, which I haven't done yet.
1 point. I don't even want to say something.
People are going to start,
Yeah.
hey, where's the math here? Yeah, we'll figure that out next year when we're talking about the halving
next in
2028.
Yeah.
Yeah. Oh man. Unless hash rate increases very quickly, we could bleed into 27.
Yeah.
It could be December 27. We'll see.
What month do you think the halving is coming in 24?
I believe it's in April. I think that we're close enough that it's not going to move around too much. And I know that there will be people are trying to plan halving parties, and it makes it really hard to plan. It's expected April 17th, apparently here. So yeah, that'll be changing. We'll see. Yeah,
That's in a few short months.
it is. Yeah, we should. But I don't think Bitcoin miners should have a party. I think we need to have like a funeral.
Yeah, this is for the Bitcoin that we won't be receiving.
Yeah, pour one out. Yeah, pour out half your beer.
Yeah. So what's going on in the Bitcoin world of news?
Yeah, so I mean, I think this gets into the Bitcoin price actually, because with the halving, that cuts the top line Bitcoin revenue in half for the whole industry. Now it's not quite in half because of transaction fees. Those are not affected by the halving.
Right.
And transaction fees have been elevated because of ordinals. But then you have to multiply the Bitcoin being added to the ledger plus the transaction fees, multiply that sum by the dollar exchange rate, right? What's the purchasing power of Bitcoin? And if that doubles, then it doesn't, the halving doesn't really affect.
Right. It nullifies the halving if we double the value of the BTC purchasing power.
Yes. And the Bitcoin price has doubled from 17,000 to 34,000 over the past 12 months.
Even shorter, I feel like, right?
Well, I mean, I'm looking at where was the price 12 months ago. It was $17,000. Right. But yeah.
Cool.
So the halvings next year in April, it's more than offset. Like, let's say a Bitcoin price doubles again, right? Now, I don't want to start making price predictions on our corporate podcast. We'll have legal come down on me. Hey, that's not investment advice.
This is not investment
financial
advice.
Yeah, past performance is not indicative of future. All the disclaimers.
Yeah.
But we're talking about a commodity here. They're talking about bananas, the price of bananas. So we'll see what happens in terms of offsetting the halving, with dollar purchasing power.
That brings up an interesting question. How does the USD inflation affect the Bitcoin purchasing power, or price?
Yeah, I think that's a great question, and one that has been controversial among kind of the market commentators, because in particular with COVID brought on an increase in inflation. And so when this acceleration of inflation happened, you had people saying, hey, look, like Bitcoin is going up in value as an inflation hedge to, because now your purchasing power is being eroded in dollars. And so it's driving you out of dollars into Bitcoin.
That's what I was going to say,
Yeah.
because like instead of, purchasing S&P, wouldn't you just purchase Bitcoin because you see that the store of value is even better? I mean, I think that with my very limited, trading experience, that the S&P is like a really good source, or really good way of holding value against inflation.
Yeah,
but barely.
Right. I think that's fair to say, especially compared to like bonds, where because it's a fixed income instrument, that inflation does erode away its value as an investment. Whereas equities, the companies earn more because of inflation.
Correct.
And so it all nets out. And so you kind of keep up with inflation with equities, kind of the general view.
That's the very, higher level way of explaining what I was thinking. Yes.
No, that's right. Your intuition's right. And I think though that where it got complicated with COVID and that inflation was that when there is inflation, you then expect the Federal Reserve to tighten monetary policy, which you would then expect to cause money to come out of the system, disinflation, and prices go down, whether it's stock prices or the Bitcoin price. And that's where we got into this debate about whether inflation was transitory or not, which was another way of saying, is inflation going to cause the Federal Reserve to tighten monetary policy or not? And what is the long-term impact on Bitcoin's value if the dollar does tighten its monetary policy? Now that we're in 2023, at the end of 2023, and the 30-year mortgage is at 8%, which is astronomical for my generation.
Yeah, I'm not buying a house anytime soon.
Yeah, and I'm not leaving my house anytime soon. But Bitcoin's price, as we mentioned, has doubled in a high interest rate environment. And now people are asking, well, what is the narrative? And I actually think that it allows us to break out of this conversation in the sense of it's not an inflation hedge. It's not an interest rate hedge. It's kind of marching to its own beat. And it exists in parallel to the traditional financial system. And sometimes it is impacted in the short term, but in the medium and long term, it is following its own cycle of fundamental adoption and not what's happening with inflation or interest rates in the TradFi system.
Got you.
Yeah.
And I was just typing into my laptop here. I don't know if we're going to discuss about it, but can you kind of shed some light onto the Sam Bankman-Fried, scenario that's going on with the FTX and all the court proceedings that are going on there and how that affects the Bitcoin network?
Yeah, absolutely. So the FTX case is, on one hand, a case of highly complex fraud. Of you look at they had this diagram of all the different legal entities because SBF's father was a lawyer who apparently enjoyed setting up legal entities. On the other hand, it was a very simple fraud of he people trusted him to hold their money, And then he took that money and kind of just spent it willy-nilly as his own money and gambled it away. And then people tried to get their money back,
and the money
wasn't there.
Yeah, there was none there.
Yeah.
So it is, in that sense, a very simple case of just fraud.
Yeah, it is.
And how does that affect the Bitcoin network or the Bitcoin community as a whole, though?
Yeah, so looking back on the rise of FTX, I think that the Bitcoin community, was pretty skeptical of Sam Bankman-Fried and of FTX.
And was that due to the trajectory and how fast that it was popularized?
It was also due to the character of SBF.
Got you.
That he had a way of kind of throwing sand in people's eyes and
pocket sand.
Yeah, exactly. And not making coherent statements, but they sounded smart.
Sure.
And so in kind of outside of our world, that worked. But within Bitcoin, it was like, this guy doesn't really know what he's talking about. And his business somehow is making lots of money. And how do we put 2 and 2 together there? Well, something's going on.
So you saw the red flags.
Yeah. Now, what those red flags were indicative of was a subject of debate. Some people were like, hey, this guy like works for the CIA, or he is in cahoots with doing some kind of insider trading type stuff and, working with his hedge fund Alameda to like provide them with deal flow and, the preferential trading and all this. I don't think anybody got to the point of saying, hey, it's a full-on fraud, like Bernie Madoff style, like the whole thing is a fraud. But there was smoke, and there were red flags for sure. And it was interesting too, because a lot of people were saying, hey, this space is unregulated and it's a Wild West. But I think what this case showed is that no, like there are rules. There are still laws. And if you do things that are bad, SBF faces like decades in prison. And the jury came back pretty quickly. Like it didn't take a lot of persuading.
Yeah, that's what I saw the prosecution come out and say is like, this was a very cut and dry case of fraud. And that's why the jury came back so fast.
Yeah. And to me, it shows that, like there doesn't really need to be more laws created. Like the legal system is functioning.
Correct. Yeah.
The bad guys are going to jail, and I think that it will deter people going forward. Now, I think it'll deter people in 2 ways. One is being more discerning about who they trust their digital assets with, but also, the next SBF will think twice about, okay, well, if I do this, like, it's not like being in crypto gives me a way of, a magical get out of jail free card. It's, you can't commit fraud no matter what the asset is. So yeah, I thought it was a really interesting case. I think there's still open questions about, his parents were heavily involved in his business, and they're not going to jail. So we'll see if that changes. If perhaps the feds wanted to put him behind bars first. There's also a lot of nonprofits and politicians that received funding from SBF and FTX. And so people are like thinking through the moral dilemma of should they have to give the money back or not? Another tidbit I saw that was interesting was that in addition to kind of giving money to nonprofits and politicians, he also did make investments. And a lot of those investments were bad investments because, he didn't care. It was other people's money.
Correct. Yeah. Yeah. But I also saw that he had donated a lot to political, campaigns.
But some of the investments actually might pay off and make people whole. So we'll see how that shakes out.
See how that shakes out.
Yeah. There's, the FTX company is in bankruptcy, and it is being led by the same guy who led the Enron bankruptcy. And there's talk of them relaunching the exchange. I I don't know how far that'll get, but there's
Which
some
is
things
crazy
that-
to me
yeah.
because I'm a, you alluded to it earlier. I'm an auto sports fan, and I just remember FTX being plastered everywhere,
Yeah.
everywhere.
They spend a lot of money on marketing.
Yeah,
And
like they were on F1 cars.
yeah, which, it was interesting for me. I was working at Kraken at the time during FTX's rise. And when I was looking at how quickly they were growing, it did strike me as odd that they had this much capital to spend, because Kraken, which had been around for more than a decade and was like a leader and had really, built a solid business, like
Weren't
we
putting
we
your
didn't have the
names
money
on
to throw
cars.
around like
yeah,
that.
yeah.
And
So where was that money coming from so fast?
Yeah. It turns out it was coming from the depositors. Kraken's the opposite. Like, we were doing like proof of reserve to like show, hey, we have all of the money that, people have deposited here. And so the juxtaposition was quite stark, that they could just go out and now, I will say Kraken now does sponsor F1 as well, but I know that they're not using depositor money for that. They're using exchange revenue to kind of grow the pie and get more people into the ecosystem.
Good.
Yeah.
That's the right way of doing things.
Yeah, I think so. I mean, and I think that it's important for the industry to advertise broadly, because
That's how we push adoption.
Yeah, absolutely. So many people have heard of Bitcoin, and their question isn't, are they interested in Bitcoin or not? They don't know where to get started.
Yeah.
And so that's why I think advertising and marketing are so important, of giving people an entry point, an on-ramp to get started.
And do you think there's like a turning point or a breaking point would be a better way of saying it, that the inflation or, there's so many issues with centralized banking that then that's the catalyst of what turns people into actually doing their due diligence and learning about Bitcoin and learning about exchanges and learning about what the history and the resource is of Bitcoin?
Yeah, because otherwise it looks like Bitcoin's a solution looking for a problem.
Sure.
But when those problems are really palpable and, Silicon Valley Bank is going under and people are trying to get their money out, then it hits them that like,
that's what Bitcoin is for.
Yeah.
Yeah.
And same, for your inflation comment earlier, it's like, it's tough though, because of Bitcoin's volatility,
Right.
that, Bitcoin's purchasing power does decrease by 80% sometimes, because it has increased by 400% before that, So, I think that you have to look at it as like a long-term store of value, and that can be a barrier for folks, but it becomes a lot easier when they're looking at the utility of not having to rely on a trusted third party.
Correct.
Yeah.
Cool.
All right. Well, we've got how long are we into?
Yeah, we've gotten a lot
episode?
covered today. We're sitting around about an hour, a little under potentially. So anything else that you wanted to talk about, or you want to sign us off?
I'll sign us off. I think that we'll revisit transaction fees because there's lots to discuss here.
Cool.
So thanks for joining us this week on Block Time. Hope you enjoyed kind of this deep dive into transaction fees, and then the conversation about kind of more recent current events. So thank you, Gabe, for co-hosting today, and always appreciate the conversation we have. Looking forward to next week.
Yeah, looking forward to it. All right. Thank you, everybody, for listening. We'll see you on the next one.